Well, thank you very much for joining us. I don't know where you will be when you be watching this event. So good morning or good evening, depending on where you are on this world. Obviously, happy to have you with us. We have this very interesting panel today to address actually the situation of merger and acquisition in the mining sector, trying to provide an outlook of the current situation, and also what are the key trends that we saw in 2021 and that will probably be replicated or actually adjusted in the next few months and years. So here joining me on this panel are three very fine gentlemen. First of all, let me introduce myself. I'm Remi Piet, so most of you know me from Embellie Advisory. We actually work a lot on in the jurisdictions in Africa and Latin America, specifically on trying to assess the capacity for projects to move forward. And I'm joined here on this panel with three very good colleagues. First, we have Verne Grinstead, who's the managing partner and founder at First Alpha Energy Capital LLP. We also have here on this panel, Chris Kololian, RBC's co-head of EMEA at Mining and Metals. And finally, Varun Talwar, head of metals and mining at the London-based Berenberg and UK investment banking. Nice to have you with me. And I'm going to be, mainly jumping right into it with a series of questions as we've been trying to prepare this panel and provide some insight. And maybe just turn to you, Verne, first. We've seen in 2021 really quite an intense M&A activity with a lot of mergers. I mean, up almost to 400 merger and acquisition in Q1 of this year. In terms of volume, that's $13 billion for the quarter. That's more than 8% increase from last year at the same time. Do you actually think that this surge will continue over the rest of the year and maybe up to 2022?
Sure. Well, firstly, thanks to Mines and Money for this conference, and I look forward to the next physical one as soon as possible. Yeah, clearly M&A has been in the forefront of all the financial pages, probably since the beginning of last year, where lots of corporate deals are getting done outside of the mining and metals sector. You've had huge amounts of private equity acquisitions, particularly in the UK, where there's a whole theme of US PE firms gobbling up dozens of UK companies, listed and unlisted. But it's a global phenomenon, I guess, to some extent driven by very low interest rates, massive access to capital, both equity and debt, and even to some extent SPACs coming to the market, where some mining deals have been done through that vehicle. But the statistics you quote are quite interesting ones, because for only $13 billion in Q1, 374 M&A deals. The average deal size is pretty small. So, I mean, I assume within that there were a few big-ish ones, although Chris, who tracks this very closely, would probably comment on that. But, certainly 374 is a hell of a lot of deals, even though the dollar amount is relatively modest. And it's continuing. You're seeing particularly activity in West Africa, in Ghana and elsewhere. You're seeing a few in Latin America, and with the base metal prices like copper and nickel roaring ahead, whereas the precious metal ones are, gold and silver are sucking wind. Those could lead to interesting transactions happening.
No, very true, and I agree exactly on this trend. Indeed, that we've seen, concentration on M&A, much more on further along projects at smaller properties, and that's why we have this disconnect between the amount of deals that we made and the size of the actual deals themselves. But maybe you mentioned base metals, and that actually gives me a very good transition to Varun. Berenberg has been quite bullish on some base metals producers recently. You have a series of interesting buy ratings also on royalty streams, precious metals and others. When we look at different commodities where you think that this M&A activity is going to be pursuing or evolving over the next few months, what kind of commodities are you actually focusing on, and do you think they're going to be pushing the trends here?
Sure, thanks, and good to be here. Look, I think I had a pretty clear idea in my head of what I was going to say, and then I saw Agnico and Kirkland Lake have just announced a mega merger in the gold space. So maybe I've got to be a bit more guarded in terms of my views of precious metals M&A. But generally speaking, 2021, I think we've seen a tale of two halves, right? I mean, first half of the year, we're still seeing a lot of that overhang of precious metals M&A from 2020. Prices were very strong. Gold hadn't started to come off yet, and a lot of the activity was being driven in that space. What I think is changing is M&A is kind of being driven a bit more by macro trends. We've got a lot more in terms of this whole green evolution going on right now. Commodity prices and base metals in particular have been particularly strong year to date. So you've probably got a lot of very cashed up mid-tier companies in that space who've been starved of good quality M&A transactions for a few years and seen a lot of their precious peers, gobbling up, attractive opportunities. And now it's kind of their time to come to the fore. So you're already starting to see that transition. Sandfire's announced the acquisition of Matsa, Atlantic Nickel's on the block at the moment. There's some very attractive prices being sort of quoted against that asset. You've got a bidding war on the go for Noront Resources between BHP and Wiley. It's pretty telling that right now where we see a lot of the activity is certainly in that base metal space. And look, I think just more broadly the role that the EV transition is playing in our sector now is actually becoming more telling in terms of M&A activity, and I think you're going to see more of that happening into next year. Just the other point I'd make is, look, at Berenberg we look at things very much from an ECM capital markets point of view, and what are the investors looking for, which is ultimately where some of the capital comes if you're not taking it from the debt markets, and it's very much those sorts of commodities. So I think, if you add lithium to that bucket, you've got a pretty good idea of where a lot of the interest is in terms of where investors want to play their equity investment and what kind of situations they want to support.
No, I mean, very true. I mean, you mentioned some very good insight on base metals, and obviously you mentioned gold. I mean, we're going to be talking quite a bit on gold operations in the next few questions. And maybe turning to Christopher, just to have an angle maybe more on specific jurisdictions. I mean, you cover EMEA, and I've seen West Africa being quite a big theater of operation for mergers and acquisitions, especially late last year with the acquisition of Teranga by Endeavour. Do you think that this trend will actually continue, and actually that emerging countries and some maybe smaller projects or ahead of more in terms of exploration in Western Africa will continue driving the flow in mergers and acquisition?
Thanks, Remy, and thank you to Mines and Money as well. It's great to be here today. In terms of West African M&A, if I think about sort of the near term, I'm not so sure that actually we're going to see a huge amount of activity. And when we think about M&A, it really stems from sort of two scenarios. One is where you have a high degree of confidence amongst management teams, and the other one is where you've got targets who may be under a bit of pressure. And I think if you look at that dynamic right now today, and you think about who the acquirers might be, some of them are probably feeling a little bit bruised right now in terms of where their share prices are, unfairly so. And then if you look at where the targets are, I don't think we see too many of the more desirable targets in any sort of distress or balance sheet issues. So as a result of that, I think you will see a little bit of that tension in terms of value gap that needs to be reconciled in the near term, that is. But I do think, and I think to Varun's point around how investors are thinking, there is a question of relevance here a little bit in terms of some of the junior and intermediate producers. In terms of our interactions with investors, we're finding that there's a little bit of a barbell approach here whereby they're looking to deploy capital among some of the larger, more liquid senior gold producers. And then they're kind of selectively looking for a bit of torque to the gold price around some high quality exploration development plays, ideally in safer jurisdictions as well. That being said, I mean, you are seeing some new entrants into West Africa. For example, Allied Gold, they're shaking things up. They've had a recent spat of successful M&A, so they're probably the exception to the rule. But ironically, actually, West Africa is actually exhibiting some great value. In the past, I think to motivate capital into the space, you really have to be a gold bull. Whereas today, actually, you can look at some of these stocks and they're trading at very healthy free cash flow yields of circa 15%. So, maybe one for Varun, but it feels like for long-term minded investors, now is actually a great time to be an investor looking at West African gold. I'm not so sure for any bankers focused on West Africa M&A at the moment, though.
No, thank you for continue.
Yeah, sorry, I was just going to say it's a really good point you've raised. I mean, companies, if we were all sort of long enough in the industry to remember what happened in the last couple of down cycles, whether they be sort of 2008 or 2015, and balance sheets today are in a much stronger position than they were going into the upcycle. So there's a lot of value that can now be transitioned across to the shareholders, which you probably weren't able to do in previous cycles because you were sort of running to catch up with fixing your balance sheets, but which were sort of broken from the previous downturn. So I think Chris raises a really good point. I mean, it changes the dynamic somewhat in terms of there's investable opportunities out there, but you don't necessarily need the M&A to always unlock them. And certainly, I think one point that comes out of it also is, capital probably isn't as scarce as it has been at previous points, and therefore, a lot of the juniors have options available to them, which maybe they didn't at various other points in the commodity cycle.
No, very true, and thank you for that direct answer. And maybe just to link Verne into the conversation also. I mean, you had made, Varun, a good point on the activity in the gold sector. Maybe Verne, if you can get your perspective on this, especially as you mentioned, more the mid-tier emerging producer space, a smaller size. M&As. We've seen Newmont acquire BT Gold in March, for example. There's rumors on Kirkland Lake Gold, for example, also. So what should we expect, maybe more of similar deals in the gold space, according to you?
Well, in regard to West Africa in particular, again, it's very country specific. So I guess Mali, where there's quite a lot of mining happening, is currently rather uncertain, given that the French have pulled out and others are moving in there to help prop up the government. But further west in good old Ghana, which has been a safe gold mining jurisdiction for 100 years or so, there you recently saw Golden Star selling the Bogoso Prestea mine to a new player, Future Global Resources / Blue International, who are looking to move into mining generally, but typically where they can also add cleaner energy and renewable energy sourcing, which is an interesting play. And then you also saw Rox Gold being sold for shares to Fortuna Silver in LATAM, which is an interesting transaction because there's zero synergies there. Fortuna is 100% silver in LATAM, and Rox Gold is 100% gold in West Africa. But the two are now together, and the market cap of the entity is more liquid than, say, just in the case of Rox Gold. So there are different objectives to why deals are happening. I mean, there is, as Varun says, there's a lot of illiquidity out there. Listings on the AIM and Main are probably being welcomed by bankers and brokers. It's a time of liquidity and deals and deal mania. But at the same time, there are plenty of listed gold stocks that have not performed at all well over the last couple of years. Looking at my regular cheat sheet, the Berenberg pricing, or market year-to-date pricings, gold, being off 8%, silver 15%, versus copper up 21, nickel up 14, and then never mind met coal up 245. It's quite extraordinary out there. Who would ever have said these price differentials would have emerged like this? Either way, there are going to be lots more deals for different reasons in each case, and some of the listed entities or private entities that are controlled by private equity firms will clearly be looking to exit during this reasonably bullish phase.
Yeah, and you did mention a very good list of different motivations behind some of those deals, whether it's diversification of assets or other liquidity objectives. Maybe one point that I found very interesting is when we actually bring in other variables to the feasibility of projects, or whether they actually make some return on investment. You mentioned potential security issues in Mali and the change of regimes here. When we look at those different elements, maybe linking Varun into the conversation. situation here, and especially, you know, the rise of new above the ground risks and evolution of ESG concerns and other, you know, social license to operate issues and valuation that you have to get when you actually acquire the different assets. When you talk about, you know, Mali facing security issues, we see, you know, change of regimes also in Guinea-Conakry, you know, certain securities in Latin American jurisdictions, you know, especially with the, you know, elections in past elections in Peru, interesting new elections in Ecuador. We actually changed the figure of Ecuador. How do you actually assess those above the ground risk and evaluate the evolution of those ESG concerns?
Yeah, it's probably one of the most topical points in investing generally, not just talk about mining or M&A, but right now, you know, not just ESG funds, but every, you know, fund out there is an ESG fund to some degree these days, because everyone has to overlay their own internal criteria as to how they you know, deploy their capital and measure the performance of companies. And I think that's now getting extended very much to how you know, at least the listed world, the corporates are reporting on these metrics. So when you take that one step further and think about, you know, how does that play into M&A? Look, I mean, it's always been a hugely important part of resources M&A, because typically speaking, companies are going to parts of the world, like we've just mentioned, that a lot of, your average person on the street doesn't really feel comfortable even talking about, probably couldn't even point to on a map in some cases. But certainly I think what's changing now is companies are becoming much more mindful of this in terms of their investment externally. So whether it be governance factors, look, social license has always been extremely important in mining, and it will continue to be so. I think the area where there's probably more scrutiny being put on companies to make sure they're doing their due diligence probably is in the environmental. This is kind of from two factors. The first one is really, you need to make sure that what you're acquiring has, proper, let's say, tailings management and enough other sort of systems in place to demonstrate that you're not acquiring something that comes with legacy issues. But we're getting to a phase very quickly where you're having to take it one step further, and as part of marketing a transaction to your investors, it's about what are we going to do from here on in. Are we going to look at electrification of fleets? Are we going to look at renewable sources to replace fossil fuels to power the processing facility? And I just think that we're getting to a world now where these sorts of factors, which were probably thought about as let's deal with it after the deal is closed, is now a core part of how you're actually selling these transactions to your financiers. So yeah, look, I mean, it's a hugely important consideration going forwards. On the security side, I'll continue to believe that perception of risk is really dependent on who you're talking about as a counterparty in an M&A transaction. The Chinese probably have a different view of risk to a Western investor. But within that, I think there's a lot that everyone can do to put more focus on things like security risks and others as part of their DD.
Perfect, and actually, that gives me a great transition to maybe Christopher. When we look at this evolution of due diligence, especially as we hopefully turn the corner on the pandemics, the capacity now of teams to go on the ground and assess those above the ground risk and include them into the valuation of portfolios, something that was probably harder to do during the pandemics in Western Africa we mentioned, or Latin America. Do you think that actually those emerging markets where you see potentially interesting deals get paid down because of the evolution of microeconomics in those countries, and some of those assets actually have decreased in price over the last few months? Do you think this is going to be a new trend for the next few months?
Yes, definitely, and hopefully that all feeds into Verne's deal mania. I like that word. But I think from an RBC recent M&A process perspective, we've seen some pretty amazing things come out of the pandemic in terms of technological advancements. Really being able to bring mining operations to life through things like virtual site visits. I think the traditional physical site visit is still going to be there. I don't think anyone, the vast majority of sophisticated buyers are not going to write a check until they've actually been to site, kicked the tires, seen the operations firsthand. And obviously that hasn't been possible with the travel restrictions, which are now thankfully starting to ease, and I think will unlock, new opportunities in that regard. I think the main change, though, I guess, and the other point to make in terms of the restrictions, it's not just about where the assets are, it's where the buyers are as well. And you think about, for example, Australia, effectively off limits in terms of outbound travel as well. And that's a very important cohort of would-be buyers. There still are, as we've seen very recently with Sandfire, for example, opportunities for Aussies to be very active and successful in M&A, but it's typically that site visit element is right at the very end in a more of a preferred bidder confirmatory approach. So I think the main change that we're seeing now in the processes we're involved with are, you're not seeing, historically you'd see maybe 5 or 6 bidders taken through to a second round and all of whom would get site visits. Nowadays, I think it's going to be a much more disciplined approach. It's going to be much more, from a seller's perspective, better use of management's time and much more targeted at who the real bona fide bidders are. And so that's probably 1 or 2 max bidders who are going to get to site. And like I say, it'll probably be more confirmatory in nature. You're not going to see, historically, you'd see a lot of bidders bidding the book in round 1 just so they could get the invite to the site visit and then, put the process at risk. It's going to be a lot more focused, I think, going into these M&A processes now. But I think on the flip side, the ability to host virtual site visits is actually a huge opportunity. And historically, where you'd have the site visit in the second round, you can actually do these virtual site visits right up front. And so you can actually really motivate champions within the bidder organizations much earlier on. And so in terms of, let's say, a BD executive taking an opportunity to his or her C-suite, then taking it to his or her board, you can actually get buy-in from senior stakeholders in a bidder organization much earlier on, and then put the necessary resources to work to actually put forward a really thoughtful first round bid. And I think everyone's a winner from that. I mean, it just saves a lot of wasted time that we would historically see in M&A processes, and ultimately a great outcome for owners of high quality strategic assets who are getting inbound interest. So I think net it's been a very positive story around technological advancements and the opportunity that will come from the easing of travel restrictions as well.
No, I mean, you make great point on the new innovations that allow to much better scheme upstream on a series of projects that could arrive to a board for decision, maybe then concentrate on doing better work on evaluating potential risks on site, thanks to lesser travel restrictions and maybe better inclusion of third parties and other actors on the ground to assess the risks. Maybe just to turn this into what you see, Verne, and we had mentioned earlier in this panel of Chinese interest and other buyers. When we look at maybe a rise of potential resource nationalisms and geopolitical disputes over access to resources potentially as one of the scenarios out there, coupled with a series of potential regulatory risks in Chile with the constitution, potential election, change of political majority in Brazil, so key jurisdictions in the near future. How do you think investors should balance their portfolios, both through commodities and maybe through companies that have operation in different jurisdictions, or what would be your advice?
Well, geopolitically and geographically, mining investing is getting more complicated. And that a number of factors are behind that, apart from potential change in Brazil, Chile, dramatic change in Peru, and then West Africa. We already touched on Mali and others that around there. Burkina Faso, previously viewed as relatively stable, has had a number of attacks there. But certainly LPs who back private equity companies are more skeptical of emerging market, and less traveled or more risky countries. I'd say 5 years ago, there would be perhaps 8 to 10 African countries that they would be comfortable with a GP investing in. Now it's probably 2 to 3. And there's a strong stated preference for Canada, US, even though large parts of the US are not that mining friendly. And LATAM, I think still Brazil is viewed as interesting. Chile, definitely. Query Peru now, although it's got such fabulous resources. And in Africa, large swathes, there are whatever 57 African countries, and if they're only viewed 3 or 4 viewed as investable, that's rather depressing, frankly. But nonetheless, that doesn't mean that deals aren't being done, and China is stepping into the vacuums left by the US and UK and Anglophone countries who have very strong anti-corruption legislation and the like, which in some cases clearly has kept them away from a number of countries and interesting mining situations, and the vacuum is being filled by Chinese investors.
Actually, on that point, I actually wanted to transition maybe to Varun specifically. I mean, you also mentioned that that's important, the fact that unfortunately a series of jurisdictions in Latin America or in Africa are not considered, solidly enough, when in truth, there are bad projects in good jurisdictions. There are good projects in some jurisdictions with a series of challenges. When actually you drill down to it, there are possibilities to mitigate them. There are different scenarios and strategies to be able to offset any kind of above the ground risk from political, local economics, through different projects, through local content, through work on regulations or different inclusion towards, social performance of your projects and better ESG inclusion. On these notes, we see also the presence of other investors, especially Chinese investors. We see cases in the lithium space. I mean, we in Argentina right now, there's actually a bidding contest on Millennium Lithium with the first bid from Jianfeng Lithium that was interesting in taking over these assets. Are we seeing potentially the increase of Chinese investors, as Verne was saying, potentially step up and dictate the pace for future merger and acquisitions, forcing more traditional investors to maybe be more bullish on certain countries that they overlook right now, where you could have very interesting projects to support?
Yeah, it's an interesting question. I think it sort of depends a little bit on the commodity group that you're thinking about. Look, I think China's going to continue to play a very important role in international M&A for what they perceive to be strategic commodities. Be they very, very large scale, copper assets, lithium projects. We've seen Ganfeng and Tianqi do a lot of international M&A in the last few years. And I think a lot of it is still being driven by the same strategy of sort of security of supply. And if you look at lithium specifically, China's prominence in the global supply chain is just unparalleled. So I certainly think you're going to continue to see a lot of that activity going forwards. Is Chinese investing going to set the pace of future M&A? It's an interesting question, because if you think about exactly the commodities I've just mentioned, there is also a bit of a shift from governments and from certain larger players reduce their reliance on China, right? So you're seeing a lot of emphasis put on building an independent rare earths and battery supply chain in places like the US and in the EU right now. And I'd argue to some degree, what I call kind of the Western Hemisphere strategy, which is to try to build integrated production routes for these key critical commodities without a reliance on China, might actually drive a lot of larger and mid-tier miners to think, well, actually, we have the strategic support to actually stretch a bit on price and compete here for certain assets. So certainly in recent times, you've seen the likes of Independence Group sort of diversifying into the lithium sector. You've heard rumors about a number of the large diversifieds, be it Tech or South32 or others, saying that they want to start looking at this space more seriously. So I think China's going to continue to play an important role, but you shouldn't underestimate this sort of critical importance of strategic metals to certain governments, and this desire to make sure that it's not a sort of China only policy in terms of sourcing raw material feed.
Yeah, absolutely.
If I could just comment on that.
Go for it.
You mentioned lithium. What about rare earths, where China produces and consumes 93% of it? And for quite a few years now, the US, the UK, the EU have been saying that they're very concerned about critical metals and rare earths and the like, given the need, the fundamental needs for these minerals, and yet not much has been done. The US ran down its stockpile of rare earths some years ago. They haven't replaced it. There are 3 rare earth operations outside China that are operating. And yet the US, UK, and EU have done nothing really much to help miners go into that space.
Yeah, that's exactly the example that I was trying to mention with geopolitical interest of securing key supplies of minerals. If I'm not wrong, but please correct me if I'm wrong, but one of the key issues on rare earth was the smeltering capacities, right? And there was a series of potential interesting investments, especially in Brazil, for smelters that would have been able to process some rare earth outside of the scope of China. And those could be very interesting indeed when you link geopolitical aspects and issues of securities of supplies, things that are different stakeholders should look into. I mean, obviously, I hope some people watching those webinars that might be interested into this might reach out to some of this and bring some ideas. But if we put in of looking with the original question to Varun and turning to Christopher, when we mentioned that China should not be the only pacer towards M&A and overlooking ideas of mineral supply chains and dictate the pace to it. Obviously, there are alternative ways, and we see also inclusion of new actors into these discussions and potential impacts on M&A. I'm thinking about potentially the entire mineral supply chain and transparency with car manufacturers, with Tesla, other actors. I mean, I mentioned Tesla, but we could mention a lot of them just for people just to see the kind of actors I'm mentioning it, and into also the inclusion of a series of new regimes with Biden administrations, other actors in the European Union pushing for these elements of more transparency, with demands from ESG funds, demands from population, sometimes overstated, but we have to see this as a trend that is growing over the next few years. How do we actually include this as into those valuations, meaning that some assets that are able to make the case of their contribution to a mining territory, of the inclusion of communities, of making the case for mining, because after all, we need mining for renewable energy, we need mining for everything that we don't grow, so that has to be the case for a series of those projects. How can we bring that to the attention of that interest and turn away from just a simple jurisdiction and classical assets to really seeing those projects and finding ways of funding them through M&As, for example? That was a very long question, Christopher. Good luck with that.
Maybe I'll have a go. Remi, if you'll permit me, I'll have a go. I mean, I think a lot of it comes down to real leadership. I mean, you're seeing a number of people really stepping out and actually trying to solve the problems that you are describing there. I think about Sibanye, for example. They've shown real leadership to make the bold decision to move away from precious metals and into battery metals. And it's early days, I think, in terms of their ambitions, but they're making a lot of waves and steps in the right direction. And they did so into PGMs about 5 years ago very successfully. So there's every reason to suggest they'll be successful here. You've got other private groups, the likes of a group called TechMet, led by Brian Mennel. Very well connected, and they've got the support of the DFC, which is effectively the U.S. government behind them, trying to again build the material flows into the EV and battery metal sector, away from an entirely Chinese dominated supply chain. So I think you're seeing, and then obviously, of course, you've got the traditional base metals players as well, and the lithium players. So I think you're starting to see some real leadership and confidence from sector players to step in and fill that void, and the capital markets are supporting them, which is great to see.
I mean, if anyone wants to comment on this,
to note that it's an unlevel playing field. So on the one hand, you have say companies listed in London, New York, Toronto, or ASX, etc., who are increasingly required to focus on ESG matters in a very real way, and at the same time having to toe a very sharp-toothed corruption and bribery acts in those countries, versus the opposition, if you like, bidding on something where there are zero handcuffs like that on that bidder. So it's an unlevel playing field, and there's no prospect at the moment that you're going to get much neodymium, praseodymium, rare earth magnet metals independently being produced and delivered within the Western countries. they're reliant on China for almost everything that they have needs for. So we've got an overlay of geopolitics going over the deal structures, which Chris was summarizing earlier, and that will lead to different outcomes, and not just who can pay the highest price for the target.
No, absolutely, and that changed obviously the narrative and the capacity of each actors on the buy side. On the sell side, obviously, I mean, it makes it two streams of potential investors, and some of them actually that also explain that for good projects that conduct sound ESG processes, they're going to see a lot more capacities for funding, because a lot of those potential institutional actors from the west side of the world, to be very schematic, are going to be battling for some maybe more limited assets that actually run their project properly, maybe geographically, agnostically on this level, maybe looking at, and as we mentioned, new countries. But do you see this as potentially also be an incentive for companies to have sound management processes, being able to communicate them and pass them along to investors, because of simply the balance of offer and demand on the purchasing of those good assets?
Yeah, I mean, I think there's a lot to be said for that. A high quality asset in a jurisdiction where a Western player feels like they can really sell the transaction to their shareholders and their board. I think those are the situations where you're going to see people stretching on valuation, because kind of to the point, how do you quantify some of the other softer elements of an M&A transaction as to what it does to your overall ESG profile, what it does to your overall risk weighting, etc. I really think that's where you start to see people being not forgiven, but at least given more flexibility to be a bit more aggressive on pricing. Certainly, you could have the best quality asset in the world, and if it's had tailings issues or something similar in the past, I think Verne raised a good point. You're going to see a sort of dichotomy where some investors just aren't going to be willing to take a look at those opportunities. Look, a lot of what we've spoken about is also about this whole integration channel. I think the other trend we're not really seeing, which everyone thought we might a few years ago, was backwards integration. Mm-hmm. So you're not really seeing a lot of the downstream players coming upstream into mining, right? They would rather sign the offtake agreements and fund the de-risked projects. But we're not seeing a trend, and I don't think any of us are bullish enough to predict that Tesla or Apple are going to go start buying mining assets in the near future. So I think that also means that the onus is still very much on the mining companies to make sure that these assets get acquired, put into production, and expanded in order to meet the strong demand there is for the commodities. And I don't really think you're going to really solve it from anywhere else at this stage.
No, very good. I mean, I agree with you indeed. In terms of when you're looking maybe to, I see Christopher might want to intervene here, maybe just transitioning to you. We talked about, good assets in jurisdictions where, traditional financiers are feeling secure. So basically those are the ones that gather every positives on the different columns. But does that mean for others that might be in jurisdictions that are more, let's say, up and coming or overlooked, maybe Ecuador, for example, or Nicaragua in the precious metal space, or in terms of, base metals or lithium, Bolivia or Argentina, in some of those countries, the equivalent you could be looking at some similar jurisdictions in the up-and-coming jurisdictions in Western Africa and even in Eastern Africa, with good projects in Ethiopia that are up and coming now. Are you looking at some of those more second level of jurisdictions being potentially moving the M&A space?
For sure. Look, I think everyone spent a long time over the last 5 years wanting to do M&A and not doing very much of it. But spending a lot of time doing their homework and looking around for high quality assets, whether it's copper, whether it's nickel, whether it's gold. Everyone knows where the assets are. And frankly, a lot of the high quality assets are in jurisdictions that people historically have resisted to go to. But we are seeing, interestingly, especially amongst Western bidders as well, large cap parties, a flexing of that jurisdiction criteria, because they recognize they don't want to flex on quality of project. They don't want to flex on governance standards and ownership levels. And so that's the one where they feel that actually, they can come in and take a partnership oriented approach with local communities and government and unlock real value. So I think the key there, though, I mean, we've talked about ESG a lot, and how do you quantify ESG in the context of, valuation? From a public equity perspective, clearly the stronger ESG champions are the ones who receive the premium valuation. Ironically, or interestingly, on the M&A side, it's much more binary. It's a necessity, and if you don't have strong ESG credentials, then bidders aren't willing to take a look. It's all downside. If sellers don't have, whether it's tailings management plans, water, labor, community dynamics, it doesn't matter, all of the above, it's all expected by buyers. And so it's not a question of sort of bridging material deficiencies with higher discount rates and therefore lower valuations. Bidders just won't engage. So I think it's really important for owners of some of these high quality assets, particularly, as you say, Remi, in some of these more frontier jurisdictions, to make sure they get this piece of the puzzle right, because what it'll do is it'll maximize the buyer universe, which of course will increase competitive tension and then lead to value maximization for shareholders.
Absolutely with you, Christopher. And maybe at this point, I mean, because I want you to be able maybe to have concluding thoughts, and maybe for our viewers and listeners to have, one or two takeaways that they should get from this panel. Maybe if I can turn to you, Verne, first, if you can maybe provide me one or two ideas that you want to summarize our thoughts that could be of interest here.
Well, I mean, we're talking about a very active time in terms of M&A, capital raising, debt, equity, even SPACs, as we discussed. I think Mick Davis has got involved in some mining-related SPAC, so it's a great time for investment banks and brokers and analysts and investors. Things are happening across the board, and in particular, having the base metals are doing so well, and then they're essentially going to be the backbone and the plumbing for a lot of EV and wind turbine and battery storage, which is being rolled out throughout globally, really, in the developed world. That's all very good underpinning for good deals, valuations, and investment returns in the mining sector as a whole. I think we haven't talked about the bulks. We haven't talked about some of the more speciality metals, where there's lots of action in those as well. But
please feel free to expand in a few minutes, because maybe some of listeners are actually very interested in this. Please do expand.
Verne, long-term met coal price forecast from you?
Well, as you guys would know, LPs have basically told private equity firms active in mining to not go near coal. Maybe 10 years ago, if you were doing met coal, you'd be okay, but certainly not thermal, even as long ago as 10 years. And it's got ever stronger. So the whole coal area is verboten in a sense for PE, although there will be some who do it and will have done extremely well out of it. And history will show that the likes of Rio and BHP and Anglo, who were forced by their equity analysts and investors to invest just after the GFC, will look back now and say, God, we sold at such a low level. Look what's happened since.
Varun, do you want to comment on this, and maybe just bridging to maybe your concluding thoughts also, so that we can actually wrap up the panel?
Yeah, sure. I mean, yeah, look, these days, unfortunately, I think all coal is off limits from a public equities perspective, and in fact, we're seeing the trend where even some smaller players are now looking to rationalize their portfolios. Having said that, there is a market out there for these assets in private hands. It's a different set of buyers to the ones we've probably been speaking about today, but that's not to say that people don't see value in these sectors. And you look at met coal and what the price has done this year. If people had picked up some of these stranded assets 12, 18 months ago, they're probably pretty happy, right? So I think there's certainly something to be said for some of the unconventional buyer groups that we probably haven't focused on as part of the conversation today. In terms of concluding remarks, look, I think as we see it, the key is always with the M&A transactions that our clients are looking to do is to just think about how you're actually going to sell this to your stakeholders. And I mean stakeholders more than just shareholders. It's about selling the full picture of how this transaction benefits everyone that's exposed to the corporate or the company. And that kind of ties back to the ESG narrative that we've been bringing up at various points during this conversation, which I think is just very important about how to frame the equity story for a company, whether or not you're listed or private. And I think it's a really important, it's becoming an increasingly more important factor in how to think about M&A going forwards.
No, very good, and thank you. And maybe Christopher can do me the honors of being the last one to speak on this panel and try to wrap this up. We actually made a very, very interesting thoughts, and I think everyone enjoyed this. I'm sure all the different panelists here would be happy to answer any question that if you actually reach out to them afterwards. Chris, please take it away, and let's try to wrap this panel.
I would just sum it up with one word to borrow from Verne, which is deal mania. The seeds are sown. The seeds are sown for a very exciting time in the mining sector. I think buyers will continue to be judicious in terms of assessing risk, but I think all the ingredients are there for a very exciting period ahead.
So basically, people are eager, waiting in the stand to get away from the gates after the pandemic, get some deals done, and we're going to see more deals probably, and more likely in larger size, not only the smaller deals in the mid-space cap that we've seen, potentially in more, let's say, frontier jurisdictions. And then I encourage, whether you're in terms of looking at precious metals, I mentioned some of the Latin American jurisdictions, also Guyana, Suriname, some of the frontier jurisdictions that we haven't mentioned but are interesting. Other in Eastern Africa, if you're in terms of base metals, there are the traditional ones from Brazil to Congo, with a change towards the ESG narratives towards this. I don't know if I wrap this up to you, but thank you very much. Let's just keep it up with the one word, deal mania. Thanks to Verne and followed up by Chris. It was a pleasure to talk to you guys, and I hope that was just a good conversation that we will repeat soon. Cheers.
Thanks very much, Remi.
Okay.
Thanks.
Very much.